Growthpoint is the largest listed South African property company on the JSE with a market cap of 36.7 billion rand and assets of over 50 billion rand. The company owns and manages 412 properties in South Africa, 40 properties in Australia, and has a 50% interest in the properties of the V&A Waterfront in Cape Town. Growthpoint has a price-earnings ratio of 23.5. If you're interested in listed property, should you be in Growthpoint? Let's start right there.
You know, you have to have an exposure to Growthpoint. They are the benchmark. Not to say they're the benchmark because they comprise 24% of the benchmark, but they are the company that all the other property companies aspire to be like. They are a very, very professional outfit, superb growth, superb assets across the board. They got, you know, between their retail and their office, I think their office are probably one of the best quality groupings of assets in the sector. Many, many shopping centres, despite the V&A Waterfront, which in its own is a flagship. They've got exposure to Lelusha, they've got exposure to Walmer Park in the Eastern Cape. They've got a wide range of assets, but more importantly, great management to
I want to bring you back to the V&A Waterfront. Is it yielding the rewards that people were expecting?
You know what, from day one, they didn't expect to see the rewards being reaped in the first year, not even the first 2 years. That is a long-term story. This is a very difficult asset. I think it's the right management team to really yield the benefit out of it. They really are starting to turn it around. They put in Ellen Gray into a brand new office over there. So there's a lot of work to be done. If you actually look at the shopping centre, remember this is a precinct. It's not just one shopping centre. There is industrial assets, there's a fishery, there's office, there's a shopping centre, but just the shopping centre alone, there's a lot of work to be done. The Platinum Mile seems really great, you know, in theory, but that strip of centres, I'm assuming, and by looking at it several times, not many people there because it doesn't really work. That's a tourist type attraction. But tourists that come to Cape Town are generally from Europe. They don't want to buy Louis Vuitton in South Africa. It works in Sandton because that's generally an African tourist coming through there, but not so much in the V&A.
Paul, does the Growthpoint story excite you?
Well, let's back up the truck a bit because the key issue is to what extent in a normal equity portfolio of the kind that viewers are putting together every day of the week, are you going to be looking at including stocks of this nature? Because for some years, perhaps 10, 15 years ago, this asset class was on the make, it was coming forward. The old days, the pension funds basically had their own property departments. And then somewhere along the line, they realized, hey, we can outsource this function by buying into listed property entities which can do all of the property management and do all the asset selection, and we can get guys that are really solid and very professional and they can do it. I think it's fine, and the fact of the matter is we're a growing economy, so we need more physical stock, we need more retail, we need more commercial space, we need more industrial space. All good. The question is really,
I hope you have a point.
The real question for me is who owns these things? They're mostly owned by people like Evan, and they are mostly owned by institutions looking for the long-term yield.
Are you saying that's an indictment that they're owned by people like Evan?
So they go up and down with interest rates is the principal driver. And yes, there are periods where you go through a purple patch and the property values do well, but I'm not entirely convinced as I sit here that these are the kinds of assets listed as they are that are going to make you big, big money in the years to come.
How do you react
I'm happy to be
that?
the culprit.
You're the culprit of owning the listed property
I'm happy
stocks.
to be the culprit to own a Growthpoint. You're 100% right. As an opportunity cost, as interest rates go up, the yield on property is less attractive and people may not see it as the best investment, but I'm not here for the short term. I'm here for the long term, and I can tell you, if you're buying Growthpoint now, it is quite pricey relative to its past. It's trading around about 7.1%, but you're getting 7.1% on day one, and it's growing, and I'm quite confident into the next 5 to 10 years on an average of 6% per annum. So
what about the risk associated with the listed property environment?
There's risk with equity as a whole. If there wasn't risk, well, then it would be an easy story to invest in. The biggest risk at the moment is bond yield spiking.
You want to jump in here. I can see you dying to put a point across.
They've done spectacularly well. I think they're like the number one part of the market. So you're a fool if you haven't been here. But I think what happened in South Africa, if you look back over the last decade, is we had an economy which was increasingly attractive to global investors. So they say, wow, why would I want to buy like a property thing that's yielding 2 or 3% in Spain when I can go to South Africa and get these like 10% yields in an economy which seems to be run by people who know what they're doing. Let's go there. The other thing that happened is that all these funds started hoovering up privately developed properties, and they were able to do that yield game where they're acquiring at higher yields and everybody's happy and everybody gets traded stuff. There's been this trend of the management teams swapping out their interest for units. So it's been a great story. and interest rates have come down, so we're in an economy now with low interest rates. Hallelujah, it all looks good, but you can't go on having those happy circumstances every decade.
Well, let's put it to Evan. Is the story over where listed property is concerned?
You know, people have been telling me it's over 20% to go, 30% to go, 40% to go, and this is in a very short period of time. In the last 3 years...
People like Paul Theron, of course.
Well, that's why my sector is still cheap, because they still don't want to buy into it. There is value into the medium to long term. Short term, you're right, as interest rates spike, there will be a pullback in capital values, but interest rates go through a cycle. And through that cycle, I can tell you, if interest rates in 10 years' time peak to 11%, and my property yields peak from 7.7 to 11%, I've done the numbers, you can grow at a mediocre 4.5%, gearing naturally to a nice little stair-head pusher, goes to 6%, and I can still give you 12%. There's still a lot of fact that there's a lot of upside. If you're not there for the short term, if you are an investor, I'm very comfortable to say you can get IRRs of close to 12, 13% in the next 10 years.
Sounds convincing. You're not convinced.
Well, I'm just being a bit chatarach here because that's what we do on the show. But the fact of the matter is you do get that great return, and I think that's fine. And there's
Hot
a
or
lot to
not
be
on
said.
Growthpoint?
Not hot enough.
Hot or not on Growthpoint?
It's term-wise, relatively speaking, the short term it looks a little bit pricey to the property sector, but into the medium to long term, definitely hot.